A shocking collapse in global trade indicates that there's no end in sight for what's already proven to be a global economic slowdown. And for businesses that are already struggling for survival, we have more signs that they're already sitting on far too much inventory and demand is outright collapsing. The scariest part is that global trade is already at its lowest level since the height of the pandemic when the world was in a lockdown. And it's not going to be as simple as simply opening up the economies all over again because we're already open. And we seem to be crashing down into, at the very least, a global recession, if not worse. But are we possibly in a recession already? Well, some shocking government data indicates that right now, this quarter is the first step into joining the rest of the world into the ever more obvious global recession. We can see here, global production of shipping containers piles up at major ports because of lack of demand for goods. Chinese container makers are feeling a hit. A top producer called China International Marine Containers saw its profits dive by 91% in the early months of this year. Another big producer reported a 71% drop. World Trade Organization experts think that export growth will continue to be slow for the duration of this entire year, for the rest of the year and on into next year. They're hinting that demand for containers will continue to stay weak. Shipping companies are struggling. They made lots during the pandemic, but now they're shrinking. With the drop in demand, ports in Asia are scrambling to find space for unused containers. Shanghai's ports, the world's biggest, has more containers now than the 2022 spring lockdown. Container shipping has cratered as ship owners try to avoid unprofitable trips. Now this is a huge turnaround because you may remember that not too long ago, there was such a demand that prices for shipping containers were just getting bid up higher and higher and higher. I believe I did a video about that about a year ago. Now we're seeing the complete opposite, where there's so much capacity being underutilized that they're actually starting to lose money. And this is quite a big problem because it all comes back to the fact that without all this pandemic stimulus, all this monetary and fiscal stimulus, that's all wiping out demand, especially as we're seeing people being forced to pay back their debts. We're going to see more and more of this in the months to come, and a story of collapsing demand is going to continue to accelerate. And ship companies say that they need higher freight rates just to cover their costs. There are too many ships in the water, leading to fierce competition and fluctuating prices. Remember during the pandemic when we didn't have enough ships? The response was loud and clear: build more ships and bigger ships. Everyone thought this high demand post-pandemic was the new normal. But in reality, it was mainly the effect of the huge financial boost that the US got from borrowing a lot and the low interest rates set by the Fed. This mix created a big storm. Everyone thought it'll keep going and never end. But apparently, that's where they were wrong. In fact, America's busiest container port complex in LA and Long Beach handled the equivalent of about 1.5 million containers, which was a 32% decline. Again, this is all part of demand, and that's what I've been talking about. New order demand is so critical because when new order demand fails, it means you need fewer employees. And suddenly it's all being validated here in the global trade data. And when it comes to demand, we can also check inventories. When we look at this chart of retailers' inventories, here's a baseline for pre-pandemic. And it's kind of normal that you would see during an economic expansion, inventory levels rise, and then the economy turns down and they get cut down. Well, here we are at kind of a peak going into the pandemic, and then we would be here if we were back at that level. So as you can see, we're well above normal. And so the problem is that there isn't enough demand to draw down these inventories. And when that happens, you really don't need as many ships moving cargo. But when it comes to these inventories, if we head into a recession, these inventory overhangs are going to be so massive that you're going to see deflation from everywhere in the retail and wholesale space, because they'll be so desperate to get rid of all this inventory. As every month goes by and every quarter goes by, the inventory just gets older and older and older to the point where they find out that perhaps maybe nobody actually wants it. U.S. economy near stalling point as consumer demand weakens. U.S. business activity approached a stagnation point in August, with growth at its weakest since February and demand for new business in the vast service sector contracted. This downturn surprised many. Experts had expected the services index to hit 52.2 and manufacturing to be at 49.3. Chris Williamson from S&P Global said that this drop in business activity in August makes us question how well the U.S. economy is really doing. He pointed out that the fast growth we saw in services in the second quarter slowed and factories are producing less. The big issue? You guessed it, Consumers aren't buying as much. Companies are seeing fewer new orders and less new business. In fact, new business and services dropped for the first time in a year and a half. In the PMI index, down to 49.2 from 51.0 just a month ago. To lure in customers, both manufacturers and service providers are just cutting prices. They're also hiring few people because costs are rising. Ironically, the Fed might see this downturn as a good thing because they're hoping for less activity to reduce inflation. Yeah, right? So let's all dance for joy now. But the good news is that the JOLTS report came in. We were expecting 9.5 million openings and we got 8.8. Yeah, this does show that a contraction is happening, which is bad. It just confirms that the economy is slowing down, but it comes at a good time because it lets the Fed know that maybe these lagging job indicators are finally catching up, and it tells them, hey, maybe we shouldn't raise interest rates in September again. We don't want to raise interest rates again in September. I'm talking to you, Jay Powell. So the best thing we can do is try to prepare. But how do we do that? We got to stop spending. I know, this is actually what causes demand to drop even further, but you know what? We know the bad times are coming and we really do have to prepare for our own safety and our own financial future. Pay off any high interest rate loans first, have some cash ready, buy crypto, buy gold, but have some cash ready so that you can invest. Prices are gonna go down, food, real estate, stocks, you name it. And the most important thing that you can do to prepare by far is to hit that like button and drop me a comment below. Send me an emoji or something. Stay safe out there.